I'm Charlotte McLeod with investingnews.com, and here today with me is Danielle DiMartino Booth, CEO and Chief Strategist at QI Research. Thank you so much for being here. Great to have you as always.
And thank you for having me. It's great to be here.
Of course, really good to be catching up with you after a little while. And I think it's the perfect time to be talking because we've got so many different data points to go through today. I thought we could start with the latest producer price index data out of the US. I believe it was up 0.9% from June, which is the biggest increase in more than 3 years. So I wondered if you could break down what's driving that rise there.
Well, clearly the tariffs are having an effect on input prices, and we've been hearing from companies that they have been shouldering higher prices, and indeed we saw that play out in the data. The question now becomes one of pricing power and purchasing power. So, how much are they going to be able to pass through to end users, to consumers at a time when, just in the month of July, we lost 440,000 full-time jobs. So purchasing power is clearly not improving. So it really does remain to be seen if this wide gap that we have between the producer price index and the consumer price index closes, and or whether we end up seeing, quite a bit of margin squeeze.
Yeah, that's one of the points I was reading about just today, that gap between PPI and CPI data that we got earlier this week shows that it's not happening yet, that increase being passed on to the consumers. So any further thoughts from you on when we might see that start to play out if it's not happening already?
Well, I do think that we will see where companies feel they can push through price increases. I think we'll see that. We saw quite a bit of food inflation in the producer price index. And when you're talking about things like essentials, and especially with very, very low margin types of sales, we could see what we call the substitution effect begin, where households end up buying other things. The classic is always that they trade down from steak to ground beef, or trade down from beef to chicken. And we're going to see whether or not that plays out. Again, we have millions upon millions of Americans working multiple jobs, working in the gig economy, not necessarily by choice. We've got a record percentage of Americans, young adults, living with their parents. So clearly budgets are stretched, and we will see where these price increases are able to be passed along. Bank of America puts out some very timely data on credit card, debit card spending, and we've seen a lot of what we call discretionary spending pressure, whether it be furniture or maybe RV sales. RV inflation has gone up quite a bit, but those sales have come down as well. So again, some difficult decisions for those who occupy the C-suite.
Right. So we'll see those businesses decide how that plays out, I guess, in the coming weeks and months. So as we've been talking about, we got those two reports, CPI and PPI this week. I know you're always really good at going beyond the headlines. So anything further you'd pull out from either of those that people might be missing right now?
So, I think it's interesting because there are several areas of the producer price index that flow through to the Fed's preferred core PCE measure. And one of them is portfolio management fees. And we saw an appreciable rise, and it really is a reflection of asset price inflation. And this is something that this is something that we talked about in 2006, 2007, 2008. How can the Fed better gauge asset price inflation? Well, there you go. If assets under management increase, then portfolio management fees are going to increase, and we're going to see that flow through from the PPI into core PCE, and that is how the Fed makes monetary policy. Will this make policymakers more reluctant to lower interest rates? We saw about a 5 percentage point decline in probabilities for a September rate hike this morning, but it's still well north of 90%.
Right, when we're definitely going to get into what's going on with the Fed. Just before we go there, I wanted to mention, so these CPI and PPI numbers, they're coming on the back of the latest July jobs data, which we got previously, after which Trump ended up firing the Bureau of Labor Statistics commissioner. So I wanted to check in with you on that, get your take on what that was all about. Does it make sense? What are you thinking about that?
Well, I think it's important to have some context and perspective. The revisions that we saw for May and June payrolls were certainly of a very big magnitude and came as a shock to market participants. But we've actually seen 24 out of the last 30 months ended July. We've seen downward revisions come out of the Bureau of Labor Statistics. To me, at least, that is highly problematic because it's indicative that there is something broken in the way that the data is being measured, whether this is response rates or in the case of May and June, they had huge downward revisions to government payrolls, and that's data that they received directly from government agencies. So that was a bit of a head scratcher. So there is something to be said for looking at re-engineering how the Bureau of Labor Statistics gathers data. Now, if you were to replace the one individual with someone who was potentially going to be politically biased, that would be problematic in its own, of its own volition. You don't want that to happen either. We want clean data and timely data to come out of government statistical agencies. I think that should be the goal here.
Yeah, I was going to ask you, okay, so do you think that this can be improved on? What are your thoughts there?
Well, the Census Bureau, for example, on a quarterly basis requires U.S. employers to report headcount numbers. That's what we call hard data. And, in the world that we live in today, of big data, of artificial intelligence, as high tech is higher than it's ever been, there's something to be said for modernizing that particular avenue of gathering the data. Can we maybe make it a monthly report that companies tell us what their head count is? And in that way, we don't have to have data imputations and the birth death model and all of the estimates that go into the critical payroll data. Perhaps we could have that be much more real time in nature. And, the technology does exist.
That'll definitely be interesting to watch how that plays out. So thanks for going into that. And I'll let us go over to the Fed now. So we had the latest meeting a couple of weeks ago at this point, but I want to start there because, of course, that's something that you're closely watching. We had interest rates stay unchanged. Anything key you would pull out from that latest meeting?
Well, I think that in something of a repeat of July of 2024, I think that there's certainly now more than just the two individuals who dissented. We've got a handful now of Fed officials who clearly think that, like July of 2024, it was a mistake to not lower interest rates this July. We got the day after. The day after the Fed met, which was a Thursday, by the time Thursday morning rolled around, Chair Jerome Powell had in his hands 24 hours in advance that payroll report that clearly demonstrated that there was nothing, quote unquote, solid about the job market. And so it's going to be very interesting to see if the Senate is able to confirm Trump's nominee to replace Fed Governor Adriana Kugler in time for the September 16th, 17th FOMC meeting. We've had several, again, Fed officials come out subsequent to this payroll report. Austin Goolsbee of the Chicago Fed, Susan Collins of the Boston Fed, saying that it's clearly evident that there's weakening in the job market, and you could see a scenario playing out where it wasn't just two dissents, and two dissents was remarkable, by the way, from governors. But you could certainly, scenario out a situation where there were 5 or 6 dissents if we get that one nominee confirmed in time for this next meeting.
Really, really interesting dynamics to watch. And of course, Powell is facing a lot of pressure to cut, and he's kind of been saying, well, we want to see how tariffs end up playing out. Does that line of thinking make sense to you? Is that something that he's going to be changing his tune on?
Well, I think certainly this hotter than expected producer price index is certainly going to give credence to Powell's reluctance to be too aggressive on the rate cutting front. But again, it comes down to the ability to pass through these higher prices to the consumers, which brings us the discussion all the way back around to the labor market, which is the Fed does have an employment mandate. And the inability to be able to shoulder higher prices, if that's because the job market is weakening and we're seeing in the data that it is demonstrably doing so, then yes, Chair Powell needs to revisit his thinking.
And on the note of tariffs, I think the last time that we spoke was back in March, and there's been a lot that's happened since then in terms of the tariffs. Do you feel like we're getting to a point right now where we're in a bit of a stasis or holding pattern with the tariffs and we can start to see how the impact plays out, or is there more turmoil to come there?
It's very hard to say. We've just had another 90-day pause with our largest trading partner, that would be China. Even though Chinese exports to the United States have decreased, they're still enormous. And so there is a certain layer of uncertainty that remains and makes it difficult for decision makers across corporate America to figure out what they're going to do in terms of growing or not growing their businesses. And so, and we've seen that play out in the data time and again with decreased capital expenditure plans. And, that is a reflection of how very uncertain the environment is. And that applies also to small businesses. We saw the 5th highest reading on uncertainty out of the National Federation of Business, just a few days ago. And so it's Main Street, it's Wall Street. M&A activity has gone down appreciably. So there's clearly uncertainty is acting as a huge governor on economic activity. I hope that we're getting to a more certain place, but I don't think that conclusion can be drawn. I think that's premature at this point.
Yeah, it's a really tough topic to tackle. So thank you for going into that one. And going back to these dynamics between Trump and Powell, it looks like one of the big headlines this week is Trump saying he's going to launch a lawsuit, or he may launch a lawsuit against Powell over these Fed renovations. Is that something you're paying attention to, or is this more just noise?
From what I've read from legal experts, I am not a legal expert, but from what I have read, legally speaking, President Trump doesn't really have a leg to stand on. And it's clear that the words that he's using, Chair Powell has exhibited gross incompetence. It's clear that Trump is trying to angle in for suggesting that Powell can be fired for cause. Of course, gross incompetence would certainly be cause for firing somebody, but that's the only reason the Supreme Court ruled that you could that you could oust a Fed leader. We'll have to see. The president also may be thinking longer term when it comes to Powell. Of course, any lawsuit would take time, but maybe he's thinking about, how much have I angered this individual? Is he angry enough to stay on past May of 2026 and finish his 14-year term as a reserve board governor that does not end until January of 2028? We shall see.
Right. Yeah. There's those two separate terms going on with Powell there. And looking at his term as Fed chair, that one is up, I believe, May 2026. And probably a good time to be asking you, what is it looking like in terms of the replacement there? What are we seeing?
You name it, we're seeing it. Treasury Secretary Scott Bessent has been very public recently in saying that he's cast a much wider net. He's looking at people across private industry. He's looking at people from Wall Street. He's looking at traditional economists. So right now it's anybody's guess. At one point it was, which of the two Kevins will it be, so to speak, Kevin Warsh or Kevin Hassett? And clearly that's no longer the case. We have so it could be anybody at this point. He might be nominating Mickey Mouse. We have no idea. But it is interesting to see how publicly the administration is going about this.
It is quite public. There's a lot of headlines going around about this too. And from your perspective, is there anyone that you would want to see or who you think would do a good job in that position?
Well, my choice would certainly be an independent practitioner from the private sector, somebody who understands better not just monetary policy, economics, but also the financial markets and how monetary policy plays out in the real economy. I think that a lot of Fed policy making in recent generations has been hampered by having far too many academics at the Fed and not enough people who are on the receiving end of monetary policy. So that would be, kind of my dream would be to have somebody who was a competent, level-headed, independent, somebody who could not be influenced by politics at all, but a very successful individual from the private sector. That would be my choice.
Okay, that's the dream there. So for Fed meetings in 2025, we've got 3 left. You've been mentioning what your expectations are, but if we lay it out, what do you see coming?
Well, so again, back to Treasury Secretary Scott Bessent, he mentioned that it would be appropriate to have a full repeat of 2024, to have had the mistake of not lowering rates in July be made up for in September with a 50 basis point rate cut. And that would lead us to the final 2 meetings of the year where we would anticipate another 25 basis points at each meeting. I think that that's perfectly realistic. There is another payroll report that's going to be released before the Fed meets again, and there'll be a lot of focus on that to see whether or not we're contemplating 25 basis points or 50 basis points.
And if we put all of this together, what are we looking at in terms of the health of the U.S. economy right now? How are you looking at that?
So, I gauge the health of the U.S. economy by the private sector, and I'm very excited for the day that we hear, instead of hearing that this or that company is going to be freezing headcount or reducing its staff or providing buyout offers. UPS, for example, just said it's got to extend its buyout period because too few of its workers accepted that. When we start to see opposite headlines, companies are expanding, growing their workforces, jobs are being created, college graduates are not bemoaning the fact that they cannot get a job. When we start to see a reversal in the tone of the headlines, I think that is going to be the true green shoot that we're looking for.
That's really helpful. And I always like to bring this back around to investors. So I think people are looking at all these data points, all of this information coming at them and wondering, okay, of course, every person is different, but how do I position? What do I make of all of this? Is there any points that you would note there?
So, traditionally, when the Fed starts to lower interest rates, it tends to be a turning point for markets. That was not the case. That was not the case when the Fed lowered interest rates. I think because the market had already started to factor in the fact that they were going to pause, and they did. They paused. So, if interest rates were at the precipice of coming down to the 1% that President Trump suggested, that would not be a good sign for investors. And because that level of interest rates would be indicative of an economy that weakened appreciably further. And if that's the case, that, true recession, recognition of recession on the part of investors, that's never a favorable backdrop for risky investments. We're certainly not there yet. We're definitely not there yet with the stock market. Momentum is alive and well and driving AI stocks to the moon. Passive investing flows are still clearly overwhelming any kind of outflows. So we're definitely not there yet. But again, there's tremendous amounts of debate going on about what the Fed is going to do next and how much easing we're going to see in the future. And until there's a little bit more certainty, I see momentum is the hardest ship to turn.
Right. And we have an audience that is very focused on gold, precious metals, hard assets, and looking for safety in that types of areas. Anywhere else like that, places of safety that people might want to go if they're feeling nervous about what they're seeing?
I mean, you can always put yourself in more defensive types of positions that have income streams attached to them. So if you're quite certain that companies are not going to be cutting their dividends, and you want exposure to the stock market, then make sure that you're also generating income from those holdings. That's one of my stock answers. The same would go for, we've been advising our clients to stay quote unquote up in quality. And that means if you are going to own corporate debt, stay up. In terms of the rating in this type of an environment when we're seeing really just a parade of multi-billion-dollar bankruptcies come through and the default rate going up.
Really helpful to get idea on how you look at that. And I will let you go unless you had any final thoughts that you would leave people with, maybe data points that you're looking for next. Any final thoughts?
So, I would be paying very close attention to the U.S. consumer right now. It is very unusual that we see credit card spending on a year-over-year basis decline. And that is what we saw. That is what we saw in the month of June. In fact, to a greater degree than any recession since 1970. So, the health of the U.S. consumer, all of these student loan headlines that, it's so easy to get bogged down in them. Pay attention, because not every recession in post-war history has even featured falling consumption. The recessions of 1970, 1982, and 2001, we actually saw the economy contract, but consumption never faltered. So the fact that we're seeing consumption come under pressure, I think, is something that people should be paying very close attention to right now.
Okay, really good point to end on there. And thank you so much for coming on today to go through all of this with us. This was great.
And thank you for having me.
Of course. And once again, I'm Charlotte McLeod with investingnews.com, and this is Danielle DiMartino Booth.
Thank you for watching. If you like this video, make sure you hit the like button and subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below.